If you think that the politicians might try and ban ownership of gold, and politicians are stupid, let's face it, when it comes to economics, they are on a completely different agenda. They will do the most stupid things. So I think it would be a bold man who rules that out. But then you ask the question, okay, if they ban ownership of gold, are they likely to do so with silver? And I think the answer is no, because it's not regarded as a monetary metal anymore. So on that basis, there is some justification for going for silver. Well, most topical is the evidence that the credit bubble is bursting. And of course, we see this particularly with the valuation of stocks. I mean, the extremes whereby people were chasing stocks on a momentum basis has now come to an end. You look at indices, and particularly the tech indices. I mean, it's a disaster. And not only that, look at Bitcoin. Bitcoin correlates with the NASDAQ pretty well because it's the same cohort of investors chasing those markets. I mean, the point about the credit bubble is that this is the largest credit bubble in history. And the easiest way to understand that, I mean, most people don't understand that we are in a credit bubble. But if you tell them that we're in a debt bubble, now that makes sense.
Right.
But credit is the other side of debt. Credit equals debt, always, always. It's two sides of a balance sheet. So if you've got maximum debt around, then obviously you've got maximum credit around. And credit tends to run in cycles. What the Austrian economists call the business cycle, in fact, is actually driven by bank credit. It's when banks not so much destroy credit, because it's the only way credit can be destroyed is basically through defaults, if you like. What they will tend to do is they'll tend to move their lending away from the private sector to safety. And the regulators say that the safest place to lend, of course, is short-term to your government, which is why the government is selling so many T-bills. So, we have that crisis. Now, I think the thing that has tripped it is particularly growing evidence that the global economy is slowing. The US economy is slowing. I mean, I think it was Atlanta Fed produced some quite alarming figures the other day, last week, suggesting that, in the last quarter or the fourth quarter or whatever, things have actually slowed very, very sharply. And we're now in a recession. And if we have another quarter like that, it's going to be a technical recession or an official recession. If you take the budget deficit, which is roughly 6.5% of GDP, out of GDP, you're then left with the private sector. And on the Congressional Budget Office's own figures, total GDP, they expect in this current year to be growing at 4.5%. So on their figures, the private sector is already contracting by 2%. And that's in nominal terms. And then if you put in inflation adjusted or just CPI adjusted, let's not use any sort of fancy numbers, just the official numbers, then quite clearly it's contracting at the rate of about 5%. Now that, by any definition, is sort of verging on a slump. So that is the background to it. And I think investors are beginning to get sort of concerned that this indeed is the case. I mean, they've ignored it so far. They've ignored it because of greed. I mean, you've got all this credit.
Right.
Oh, and the other thing, of course, if you look at the FINRA numbers for margin accounts, that's now close to $1 trillion. $1 trillion of leverage in the US stock market. And the bulk of that, I guess, we don't know for certain, but the bulk of that, I guess, was sort of chasing fancy tech stocks. So, this bubble, when it bursts, I think could be rather nasty. And the other point I would make about it is that not only do we have a mega credit bubble bursting, we also have Smoot-Hawley Mark II tariffs being brought in by Trump. And already you see, the new prime minister in Canada saying, we're going to hit back with our own tariffs and all the rest of it. This is what happened in 1930. So we've got exactly the same combination, but this time it's actually a lot more violent. This is not good. So I am extremely pessimistic on the outlook for stocks. I think that they will fall so much that stocks value as collateral will start, if you like, upsetting the banking system. We already have a commercial real estate disaster in America. I also think that, obviously the Fed is going to do what it can to try and rescue this situation. But the extent to which it does it is going to undermine the dollar. So what are the foreigners going to do? The foreigners are going to say, we don't want our dollars anymore. It's quite simple. Now, their own currencies, I have to say, are in a similarly powerless condition. So what do they do? The only thing they do is just get out of credit and get into real money, which is gold. And so a brief summary of the current situation as I see it. As I said earlier, this is the biggest credit bubble in history, and it's going pop. And it's doing so in exactly the same circumstances that we saw between 1929 and 1932. That's actually all you need to know. And the idea that anyone can sort of manufacture this, or some wicked globalist has decided that it's time to pull the plug or all the rest of it, is actually rubbish, because these guys haven't got a clue. You're beginning to see some appreciation of the dangers. And interestingly, according to the World Gold Council's most recent figures for the last few weeks, at long last, some funds in the West are beginning to buy gold ETFs. Until then, the interest in gold ETFs has been virtually zero. We're now beginning to see that, and I think it's probably some of the larger funds realizing that the sort of, if you like, the risk in their portfolio is actually got pretty high. And this is something they need to sort of, if you like, offset the bet. Yeah. Well, I think with GLD, I think we ought to bear in mind that the authorized participants, as they're called in the prospectus, aren't above borrowing shares and then liquidating them to get hold of the physical. So I think we have to be slightly cautious about taking those figures on face value. I would suspect that if you remove that factor from it, you would actually see that GLD is growing. But it is interesting what you say, that it seems to be certainly spreading into, let's say, the better quality second line ETFs. What's interesting in that is that Eric Sprott, I think, has got a wonderful name amongst those who follow gold, sort of have some sort of understanding, if you like, of the difference between credit and real money. I'm probably being quite kind about their knowledge there, because most of them are just gold bugs, as it were. But I think if you're looking to diversify out of a portfolio which is invested in the normal stuff, then I think Eric Sprott's name probably is one that's on your radar, and he's got a good reputation. He's also got a good reputation as a stock picker. Certainly in Canadian minds, because he's been chairman of this, that, and the other thing. He knows all the managers. He understands the geology and all the rest of it. And I'm sure that he gets a lot of quasi inside information, as it were, from his position, and he can evaluate it from that knowledge. So. And of course, he's very much in the van when it comes to financing, exploration, and all the rest of it. So, if you want to buy into this sector and you haven't got a clue what you're doing, follow Eric. It's a no-brainer, really. The first thing I would say is it's not gold and silver going up so much. There is an element of that. You can't disentangle it, but it's basically paper currencies going down. This is actually what the central banks see. The reason that central banks are buying gold is that they're actually selling fiat. And That is a very important point to understand. Ultimately, when everybody understands that it's fiat going down and not prices rising, and we're not just talking gold at this stage, but we're also talking about, groceries and everything else, then the currency is doomed. So we are on the beginning of that curve, well, in fact, we were on the beginning of that from 1971, when we started in 71 with $35 an ounce, and we're now close to 3,000. But obviously, the way people think, they're not thinking like that. So they're trading it as if it was a stock or whatever. And I would personally think that 3,000, there could be some consolidation around about that 3,000 level. It's a view. I wouldn't sell on the basis that there's going to, it's going to consolidate and it might tip back and you might be able to do this, that, and the other thing. Why? Because if I sell gold, I'm buying dollars. I don't want to buy dollars. For goodness sake, I want to get the hell out of them. So, that's the emphasis I would put on it. And as far as silver is concerned, I think with the gold-silver ratio close to 90, that to my mind is far, far too high. Silver does have a monetary role. There is absolutely nothing in the price for a monetary role at the moment. But I think when you get the collapse of currencies, silver has got two advantages. Firstly, it's, somebody said it's the poor man's gold. I think that's actually, a sort of a reasonable description for the role of silver in terms of being useful for smaller transactions. I think that's the first thing. The second thing is that if you think that the politicians might try and ban ownership of gold, and politicians are stupid, let's face it, when it comes to economics, they are on a completely different agenda. They will do the most stupid things in economic terms. So I think it would be a bold man who rules that out. But then you ask the question, okay, if they ban ownership of gold, are they likely to do so with silver? And I think the answer is no, because it's not regarded as a monetary metal anymore. So on that basis, there is some justification for going for silver. And my view is that, traditionally, when you get a rise in the price of gold, silver tends to rise about twice as fast. The problem with silver is that when gold stops rising, it falls, probably not only twice as fast, but it keeps on falling when gold goes nowhere. So that's the sort of problem you've got with silver. But having said that, it's got left way, way behind. And we've had, particularly if you ignore the, selling of ETFs about 5 years ago, silver ETFs, we've had about 7 years of supply deficiency. That's according to the Silver Institute's numbers. And I think it's also been a very managed commodity. I point the finger at China for managing the silver price. And whether I'm right or wrong, I have no doubt that it has been very, very suppressed. And on that basis, I think the suppression has probably come to an end. And I also think that the bullion banks, they're desperate to try and bring their shorts in. I mean, it's interesting, and I think to some extent the sudden premiums that we saw on COMEX, and we saw the price rise something like $200 while open interest fell 75,000 contracts. I mean, that's a bear squeeze. And who are the bears? The bears are the establishment. They are being squeezed. And I think they want out of this short position. So that is another factor which is likely to really affect the price. And I think, I think it was DB was the name of your correspondent. If we get up to that sort of $3,000 level, then there could be some panicking on the short side, as it were. Because it's not really the longs who have been buying futures too much. I mean, I think it's shifted a little bit because I see open interest on COMEX has risen to just close to 500,000 contracts. I mean, that's not overbought by any means. And we could go another 100,000 contracts to the 600,000 contract level before you say this market is overbought. So, Yeah, I mean, I think there's quite a lot of bear squeeze potential still in there. And 3,000 could be a Rubicon, I think, for quite a lot of the bullion bank traders. Interesting position. No, I don't think it's a flight to safety. I think what it is, it's two things. I mean, firstly, COMEX has had stands for deliveries over the last 4 years to last December of over 2,000 tons. I mean, we're talking about a lot for a contract that was never ever meant really to be used as a means of acquiring bullion. If you look at the pace at which these stands for delivery have continued since January the 1st, it's continued at roughly 4 times the rate of last year. I mean, if we continue at this current pace, we're going to see 2,000 tons standing for delivery in this year alone.
Wow.
Now, where's that going to come from? And I think this was what that is, I think, a factor, if you like, behind the squeeze on the establishment. Because the establishment doesn't deliver when you get a stand for delivery. It'll make every excuse not to deliver. So, you've got this backlog, if you like, of, sort of, well, don't worry, we'll give you a piece of paper saying that, yes, it is yours after all sort of thing. But, we've got logistical problems. We can't get your gold to you just at the moment. We'll let you know, and you don't hear anything, and you chase them and you say, oh, well, there's been a slight problem here, all this sort of rubbish. So you get that delay. Now, that delay means that there has been this backlog building up of gold yet to be delivered. And the only cure for this, I think, has been this bear squeeze, whereby the premium on the futures has generated an arbitrage, a very profitable arbitrage. I mean, as much as $50 an ounce, whereby, bullion, which is sort of, let's say, part of the global liquidity, including in the vaults of the Bank of England, has just being sucked into the COMEX warehouses. But that's what it is. I think it's purely that huge great premium has created an arbitrage. Yeah. Well, I think what Simon was referring to was that it shouldn't take 8 weeks, which came out in the Financial Times article. It shouldn't take 8 weeks in order to deliver, a couple of 100 tons of gold or whatever. Now, I'm not too sure about that. I think to say that the bank is effectively defaulting, I think is probably wrong. I think it's more a logistical problem. The bank has the gold there. Of that, I'm absolutely certain. I don't know who owns it. It may be twice owned. I mean, that could be a problem. For example, if, let us say, you have leased gold and you effectively possess it, you are the owner over the duration of the lease, then unless there's something in the wording of the contract that you have with the Bank of England, i.e. that it must remain stored in the Bank of England, then you can take it out. I don't know whether there is that wording. I would have thought, for goodness sake, if I was running the bullion operation, knowing that in earlier times, gold had been leased and it had disappeared and not returned. This was the point that Frank Venerosa was making in Lima in 2002. Upwards of 10,000 tons, he reckoned, had probably disappeared from the central bank's vaults. So there's a lot of this double counting. And of course, when you start taking gold out of the Bank of England's vaults, the double counting becomes a bit of a problem.
Right.
So I think rather than saying that the Bank of England is defaulting, I think what we could be seeing is the beginning of the collapse of the entire system. And I was very interested in an article which I can't remember who did it now. But which sort of talked about leased gold being rehypothecated. So 1 ton of gold becomes 100, as it were. And as you unwind that, I was Jim Rickards. That's who was saying this. But as you unwind that, then obviously there are going to be some very, very serious consequences. And so we could see this as being the beginning of the demise of the paper gold system. Now, if that is the case, then because it is central in terms of collateral, tier one asset, whatever you like to describe it as, then this has ramifications for the whole of the derivative industry. And we're talking about hundreds of trillions of obligations, which, if you like, rest on this point of the pyramid, with gold being the solid point at the bottom, and the rest of it is all sort of on top, like the Exeter pyramid, if you like.
Right.
So this is something that we do need to watch very carefully, and particularly in conjunction with the bursting of the credit bubble. I mean, the whole thing is all happening at the same time, which means that, if you like, the financial landscape could evolve extremely rapidly, with everybody wondering what the hell's going on and where is my wealth gone? My wealth has disappeared. So no, these are very, very interesting times, and I think it is very, very important for people to follow very carefully credible analysts, who understand this sort of thing.